Good afternoon, ladies and gentlemen. Welcome back to the first weekly market review for the month of June, 3rd of June. Today, I have my co-host with me, Mr. Gerald Wong here. Seems to be looking good today. How are you, Gerald?
Hi, Sunny. Hi, good afternoon, everyone. Yes, you're right. We are now in June, almost close to the midpoint of the year. We saw quite a number of developments in the Singapore market last week with a few big movements. So hope to be able to share these developments with the audience today.
Yes, not only the developments in Singapore, in US, I remember just last week we were talking about Dow dropping 600 points, and last Friday we have Dow rebounding 570 points again. And on Singapore side, we have some big order wins for some of our companies, as well as sets starting to reap the rewards of WFS acquisition. So I think you will go through some of the details with us today, correct?
That's right. So as usual, whatever we are sharing today will be for information purposes only and should not be taken to be financial advice. Okay, we have an upcoming Ask SIAS for members of SIAS. This is on the 12th of June. If you are keen to participate, you can scan this QR code, and registration closes next Monday on the 10th of June. Okay, if you find the weekly market review helpful, do leave us a review on Google. And if you're wondering how you can join SIAS as a member, you can scan this QR code or go to this website, sias.org.sg/membership. Okay, the membership for SIAS will cost $12 per year or only $1 per month. Okay, so as Sunny mentioned, last week we saw some movements in both the US market as well as the Singapore market. As a whole, the US market was down slightly, with the S&P 500 down by 0.5%, and the STI performed better, up by 0.6%. Okay, what actually happened in the last week was that we saw the minutes of the US Federal Reserve meeting being released. And what came through from the minutes is that Fed officials indicated that they do not have the confidence to cut rates as yet. This because inflation has been more persistent than expected. Okay, so what we saw was a bounce in the US bond yields from below 4.4% to above 4.6%. Okay, but thankfully, on Friday, because the core inflation numbers came out, what we saw is that the Fed's preferred inflation measure was just slightly below the market expectations. So that helped to bring down the bond yield slightly and a slight recovery in the US market. But overall, what we see would be a lower probability of Fed rate cuts this year. Okay, so previously, if you recall, we were saying that there might be 2 rate cuts in 2024. At this point in time, what we see is that currently there's just expectation of 1 rate cut this year. Okay, so the December rate cut that was supposed to happen, the probability is now increased towards the likelihood that we might see the rates being maintained in December as well. Okay, so what this means is that we might see just 1 rate cut in September. And even then, it seems like it is quite close as to whether we might even see this 1 rate cut coming through. Okay, moving closer to home, the Singapore market saw quite a number of big movements last week. Yang Shipbuilding was up by 20%. Okay, quite rare that you see a Singapore blue chip stock moving up so much within a week. We also had Seatrium that was up by 14.3%. Okay. Next, sets up by 9% and Singtel 2.5%. Okay, so these were the stocks that helped to lift the STI. Okay, in terms of the top losers, we had Jardine Cycle and Carriage, City Developments, as well as Mapletree Logistics Trust. If you recall, we mentioned the MSCI exclusion earlier. So that took place at the end of Friday, and that brought down the stocks that were removed from the MSCI Singapore. Okay, there are a few stocks that I wanted to share a bit more today. These are stocks that were commonly discussed and asked about in the past week. We start with Mapletree Pan Asia Commercial Trust, trading close to a 52-week low at $1.22. What they announced last week was actually the divestment of one of their assets, Mapletree and Sun. This is for a consideration of about $775 million. Okay, so this 775 million is above the valuation and also the original purchase price of the asset. Okay, so we'll look at why Mapletree Pan Asia Commercial Trust went ahead with this divestment. Okay, a few reasons that they suggested. Number one, to be able to strengthen their capital structure. Number two, this divestment would be accretive to unit holders. Number three, as we shared earlier, that represents a gain over the latest independent valuation as well as the purchase price. And with that, they will still have Singapore as having a significant portion of their portfolio. Okay, so these are the pro forma effects, how the balance sheet will actually change with the divestment. Their gearing will come down. Okay, so that might be a relief to some unit holders. Before the divestment, their leverage ratio was at 40.5%. Post the divestment, it will come down to 37.6%. Okay, and with that, they will be able to have better interest coverage as well as a larger debt headroom. The other positive effect, like we shared earlier, it will help in terms of being accretive to the distribution per unit. Okay, so what we see is that based on the company's estimates, it will help to boost the distribution per unit by about 1.5%. Okay, if you are thinking about how it will affect the portfolio thereafter, if you look at where this property resides, it is an office asset in Singapore, so under other Singapore, and this portion will come down from 11% to 7%. Okay, but even with this decrease, Singapore still contributes about 58% of their net property income, most of which is actually made up of MBC as well as VivoCity. Okay, so with the remaining other assets in Singapore, that will in the end make up about 58% of their net property income. Okay, so if you're looking at the valuation of Mapletree Pan Asia Commercial Trust at this point in time, given that the share price is close to a 52-week low, the dividend yield is also at a very high level at about 7.4%, which is above the historical average dividend yield of 5.2%. Okay, on a price to book basis at 0.7 times price to book, which is below the historical average price to book of 1 times. Okay, next, Seatrium, stock with a lot of share price movement. We saw that it had a jump in late April after the share consolidation, then came down after the news of the MSCI exclusion, and then bounced last week with the news that it has won an 11 billion order. Okay, so what is this 11 billion order? This is for 2 floating production, storage and offloading units, which are oil production assets. And this order is from Brazilian oil and gas company Petrobras. Okay, with this, their order book would increase to 25.8 billion, which will comprise of 31 projects, which will be delivered progressively until 2030. Okay, in terms of how this may potentially help, if you look at the FY23 revenue, it was at 7.3 billion. Okay, so the order book is a sizable part of its significant ratio of what its revenue is. And if you're to look at the underlying loss in 2023, it was at about 28 million. But if the order book were to be progressively recognized, that may help to boost the revenue and help to bring the company back to profitability. Okay, so with that, the company hopes to be able to achieve a EBITDA of above 1 billion by 2028. That will help to bring its return on equity to above 8%. Okay, so we'll see whether with the improvement in order book that will help to drive the company towards better profitability. Okay, last but not least, we have got SETS. A very big movement in the share price last week as well, up by close to 10%. And with that, we have seen SET share price moving from about 240 in late April to about 280 as of Friday. Okay, so SIAS actually reported their full year results ending March. And what we see here is a very big increase in its revenue, its EBITDA, as well as its net profit. Okay, part of it is driven by the acquisition of WFS, which is a cargo business that they acquired last year. Okay, so with that, we see that revenue for SETS increased sharply from 1.8 billion to 5.1 billion, EBITDA from 173 million to 890 million, and the profit actually reversed from being a net loss in FY23 to a 56 million profit in FY24. Okay, most of the turnaround came through in the fourth quarter of the year. Okay, so if you look at the company's profit, the net profit from continuing operations increased both compared to the previous quarter as well as the previous year. Okay, so 39.5 million net profit from continuing operations, an increase from the 33.5 million in the previous quarter. Okay, if you're to look at the progression of the company's latest trends, we see this across various metrics such as the flights handled, cargo tonnage, meal served, and effectively what helped the bounce in the fourth quarter is a very significant increase in the meal served from 14 million to 15 million between the third quarter and the fourth quarter. And that helped to offset some of the slight decline that we see in terms of the flight handled, the cargo tonnage, as well as the non-aviation meal served. Okay, together with the increase in profit, we also see an improve in its balance sheet. The operating cash flow improved. The debt to EBITDA level came down, as well as the so this is actually something that has been helped with the improvement in the operating cash flow generated. Okay, compared to the previous year, the debt to equity has still gone up, and this really a result of the acquisition that came through over the past year. Okay, so quite a number of movements in the Singapore market. We have a few developments to look out for in the market this week, including the US non-farm payroll data on Friday. We also have the ECB meeting on Thursday that is closely watched because that might be the first rate cut that is coming through from the ECB. And for those of you who are interested in the T-bill, we have a 6-month T-bill auction that's coming up on the 6th of June. Okay, so with that, I'll hand over to Sunny, who will share the technical analysis.
Okay, thanks, Gerald, for the updates on some of the Singapore markets movements. Let's go through the STI index chart first. On this Monday morning, we are seeing that STI continue to power upwards, and I believe we have a new year-to-date high on the 3rd of June today. Okay, market is up about 6 or 7 points in the morning. So what happened in the past week was STI did have a very strong uptrend performance. We are up about like 0.6% last week. And you can see that the STI is using the 20 days moving average or the Bollinger Band basis as a support level to trend upwards again. So we were talking about where should we be looking at to get into the STI index. We are looking at somewhere between the 20 days moving average and the 50 days moving average, which has not been challenged or have not been retraced back to at this point of time, given the strong momentum we see in the SCI index right now. So the question is, do we start chasing the rally, or do we continue to wait for a pullback and be patient? My personal opinion would be, I don't like to chase rallies. I like to wait for the market to come to me. So I would still prefer to wait for the market to retrace back at least to the 20 days moving average, as you can see over here, has continuing to be a very good support for the SCI index, and it's currently around the level of a 3,300 points level. Okay, market is touched a high of 3,351 points in early morning trade. Okay, on the indicators wise, MACD is still trending in a sideways movement, not telling us any signal, but market continue to be trending higher. On the RSI, we have been using the 14 days RSI moving average as a support for the RSI to maintain around the level of 60 to 65 points level. So that is why there's still positive momentum in the market right now. However, at the 65-point level this morning on the RSI, we are also very close to the 70-point overbought conditions, which could indicate a retracement. So thereby, I believe my opinion still stands that I'm not chasing this rally. I'm waiting back at least for a pullback to the 20 days moving average to accumulate. If it's fall further, then we can accumulate more towards the 50 days moving average. Okay, so that is my take on the STI index. Next, let's move to the more choppy roller coaster ride of the US indices, starting with the Dow Jones index. So last week, weekly market review, we touched that Thursday over here, 23rd May, we saw a 600-point decline in the Dow Jones index, which was the worst trading day of this year. And last Friday on 31st May, the last day of May, the month of May, we got a big rebound of more than 570 points. So what does that tell us about the market? So firstly, this big rebound, as what Gerald mentioned, was the results of the PCE data announcement, which is in line with market expectation, meaning that inflation is not increasingly higher, but largely in line with what most economists is expecting. So what that tell us is, as long as going forward, the market data, CPI data, PCE data, inflation data are in line with what market is expecting, or showing signs that the CPI is coming down, inflation is coming down, then market would have a positive reaction to it. Unless there is a negative data that's coming out, then market would move otherwise. So as long as data is in line, we should see market continue to trend higher. Okay, so on key levels on the Dow Jones index, we can see that in the previous week, we said that once it comes back down to the 20 days moving average towards the 100 days moving average, which is the amber line that you see here, it is an opportunity to accumulate. So this is our chance to get back in on the Dow Jones index, with the bounce on last Friday giving us a lot of confidence. This bounce also coincides with the lower bound of the Bollinger Band that you can see here. So the big rebound that we see on Friday was not really a surprise, and also supported by some technical readings on the Bollinger Band as well. On the MACD indicator, we can see that the crossover of the MACD line, which happened last week, this downtrend momentum, according to the MACD histogram, has started to subside as of last Friday. And of course, one data point does not constitute a trend. So let's say if we see another data point of the MACD indicator or MACD histogram showing continued sign of subsiding downtrend momentum, then this rebound is likely going to continue upwards. And the next target I'm looking at, of course, will be the year-to-date high around the 14,000 level handle, with the next target around the 14,300 points level, which is the upper bound of the Bollinger Band. On the RSI indicator, we touched a low of about 34 points, so we did not breach the 30-point oversold mark, and market had a rebound last Friday. So that means that we still have a slightly weak momentum on the RSI, but the gain in the RSI momentum reading is pretty encouraging. And once it breached above the 50-point mark, that could also mean that the Dow Jones index might continue to accelerate upwards again. Okay, so this is what the technical indicators are telling us, and we are at a very good support zone of the 100 days moving average, as well as the lower bound of the Bollinger Band, giving support to the Dow Jones index right now. Next, let's move to the broad index, the S&P 500, which was not as volatile as the Dow Jones index, but nonetheless, you can see last Friday, we do have this very clear hammer candlestick pattern, which is an indication that market is likely going to rebound higher. Okay, so the year-to-date high of S&P 500 is still around the level of 5,340 points. So we are about 70 points away from that year-to-date high. And we also, in the last weekly market review, we said that once it hits the 20 days moving average, which is the black line over here, it will be a good time to accumulate, and that happened in the last two trading sessions. Of course, if it gets nearer to the 50 days moving average, that would be a more stronger support level to look at for the S&P 500. But nonetheless, you can see that the candle wick or the tail end of that candlesticks on the S&P 500 has actually breached into our support zone of around the 5,200 points level, which means it could also be time to accumulate on the S&P 500 going into the second half of the year. So the MACD indicator is showing negative reading right now, which means that there's negative momentum in S&P 500. So if it pulls back further to the 50 days moving average, which is the blue line, now at about 5,170 points, or even the lower bound of the Bollinger Band at 5147 or 5140, that would mean that investors could be considering to accumulate further. And of course, you can see that the volume on last Friday is another indication that this could be a very strong rebound should market retrace further. The RSI managed to stay above the 50-point neutral mark with the latest reading at 57. So positive reading there on the RSI indicator. And that would also mean that we have some kind of a contradicting signal between the RSI and the MACD indicator. So until the MACD indicator show some sign of a subsiding downtrend momentum, that will coincide with the RSI, market would have a better, good rebound from there. So I believe that is coming, and do look out for that, especially with the non-farm payroll data coming out this Friday. Lastly, let's go to the tech-heavy Nasdaq Composite Index, which sort of have a tick down lower on Friday as compared to some of the big wins that we see on the US index. I think this is not a surprise because throughout those weeks, especially on the announcement of the NVIDIA results, we have seen the Nasdaq Composite Index extend upwards a lot by quite a bit. So the index did not really finish in a positive low last Friday, but that does not mean that the market is turning. Okay, so on the charts, I can see that the last Friday candle wick of the Nasdaq Composite Index actually breached the lower bound of the breached into the lower bound of the Bollinger Band area and breached the 20 days moving average, and we are closing in towards the 50 days moving average, which was what we said last week should be the level that we should be looking at to accumulate for the Nasdaq Composite Index, because the Nasdaq Composite Index itself is slightly more volatile than the other two indices. So it's good to take a bit of a more prudent approach when trading into the Nasdaq Composite Index. So it has not breached the 50 days moving average right now, which is around the 16,300 level. So I think we need to be a bit patient, because on the indicator wise, the MACD indicator just turned negative last Friday, and that could mean that this downward movement or downward momentum may accelerate, and until we get some sign of reversal from the MACD indicator, that could mean that the reading on the indicator now is that the Nasdaq Composite Index is likely to pull back a little bit more. On the RSI, actually last week on Tuesday, we hit the 70-point mark, which was the overbought level. And that means that the Nasdaq Composite retracement is not a surprise, because the indicators is showing signs that the Nasdaq Composite Index is overstretched and gone into overbought territory. Hence the retracement in the last 3 or 4 trading sessions. So the latest RSI reading at 57 has retraced quite a bit, and you can see that from the last 2 trading sessions, that decline in the RSI reading has more or less subsided. And as we inch towards the 50-point reading, I believe that could be the area where the Nasdaq composite index will hit into our support zone of the 50 days moving average. And that could be the point where we need to be alert to accumulate on the Nasdaq composite index again. Okay, so these are my observations of the markets on the charts in the last week. And I believe market going forward will second half of the year will likely be positive with everyone expecting a rate cut coming soon. So anything to add, Gerald?
Thanks, Sunny, for the update. I think a lot really depends on what we see for the US non-farm payroll data that's coming up on Friday. We are going to a relatively period for results. So the macroeconomic data points will probably set the direction for the market in the coming weeks.
Okay. Thanks, Gerald. So I think that is all the time that we have for today. Thanks everyone for tuning in to this weekly market review. And we'll see you next week on Monday again. And at the same time, in the meantime, please trade safe and stay safe. And thanks for tuning in. And goodbye.
Thank you.